The following part of this video will introduce some explanations relating to credit creations such as loan term, repayment period, debt rescheduling, grace period, etc. Let's begin with the term loan term. Loan term refers to a period starting on the day following the day when a credit institution begins to disburse the borrowed fund to a customer and ending on the day when the customer has to repay principal and interest amounts in full as agreed upon between the credit institution and customer. Where the last day of the loan term is a holiday or weekly day off, the next day will be taken as the last day of the loan term. If a loan term is not a full day, the provision enshrined in the Civil Code on the date of commencement of a term is applied. The loan term, whether short or long, depends on various factors such as the business cycle of borrowers, period of capital recovery, solvency of borrowers, and source of funds. The second term is the repayment period. The repayment period refers to a set period constituting the agreed loan term, and at the end of each of these periods, a customer is obliged to repay loan principal and/or interest amounts in part or in whole to a credit institution. Let's look at this example. Suppose it has the amount of 4 billion Vietnam dong and the loan term is 4 years. This means that the repayment term of this loan is annual. Each year, the borrower has to repay the debt one time to the debtor. From this example, it can be said that a loan may have one or more than one repayment period. The last repayment period must coincide with the maturity date of the loan. The repayment period is determined based on the characteristics of receivables of the borrower. The third term is debt rescheduling. Debt rescheduling refers to a credit institution's consent to adjustment to a repayment period or extension of a loan term according to the following provisions. Adjustment to a repayment period. Extension of a loan term. One form of debt rescheduling is an adjustment to a repayment period. It is defined as a credit institution's agreement to extend the agreed period of repayment of loan principal and/or interest in part or in full, including cases in which there is no change in the number of agreed repayment periods, while the loan term is kept unchanged. Another form is the extension of a loan term. It means a credit institution's agreement to extend repayment of loan principal and/or interest for a period exceeding to agreed loan term. Hence, extending the agreed period of repayment only changes the period of repayment, but the loan term is not changed. For extension of a loan term means the loan term will be extended longer than the agreed term in the credit agreement. The debt rescheduling must be conditional. Please carefully read the conditions of debt rescheduling in the lecture notes and relevant legal regulations. The grace period normally regards medium or long-term loans. This is the period from one day before the first repayment period. In the grace period, banks usually offer preferential interest rates to customers. The repayment term is defined as the period from the date of the first repayment period to the date that a customer fulfills the obligation of repayment in full of principal and interest. Thus, the loan period includes the construction time, or it can be called the grace period, and the repayment term, in which the grace period is from the first disbursement date to the end of the construction period. The repayment term is from the first day of the repayment period until the date that the customer pays off the entire debt including principal and interest. After introducing the terms related to the terms of loans, now the terms related to the loan amount will be discussed. The first one is an outstanding amount of debt or outstanding amount. An outstanding amount of debt is defined as the amount of money that a customer borrows from a credit institution at a given time. From the perspective of commercial banks, it is also the amount of money that a credit institution has disbursed to a customer but has not yet recovered. The following term is loan volume. It presents the total amount of funds that a credit institution has disbursed to a customer in a period. Loan volume reflects the results of the expansion of lending activities of commercial banks. The opposite of loan volume is volume repaid. It represents the total amount of funds that a customer has repaid to a credit institution in a period. The volume repaid in a given period increases means that in that period, the amount of money recovered from borrowers increases. Along with other terms, it can indicate the effectiveness of debt collection activities and the credit quality of commercial banks. The following term is credit limit. The credit limit is the maximum outstanding amount of debt that the credit institution guarantee offers to a customer. The credit limit is available for a specific time, normally 1 year. The total credit limit is the total outstanding amount of debts of all forms of credit extension for a customer, including lending, discount, factoring, guarantee, etc. Credit turnover indicates how many times the average outstanding amount of debts is collected in a period, normally 1 year. Credit turnover indicates the speed of volume repay that banks collect from borrowers. This is an important indicator calculated annually by banks to assess the ability to organize credit capital management and credit quality in meeting customer needs. This coefficient reflects the number of credit capital turnovers and is determined as follows. Credit turnover equals debt collection turnover in the period divided by average outstanding loans in the period. The higher the credit turnover, the faster the bank loans participate in many cycles of production and circulation, save costs, and create great profits for the bank. Overdue debt and bad debt are quite familiar terms. Overdue debt, or loan, refers to a part or the whole of loan principal or interest that a borrower fails to pay by the due date, as agreed upon with a credit institution. Bad debt is a debt which has been classified as those Group 3, 4 and 5 stipulated in Decision Number 493/2005/QDNHNN. After disbursement, the loans will be assessed the quality. Depending on whether the quality of loans is good or bad, banks will have to set aside risk provisions for those loans. Those activities are regulated under Circular Number 11/2021/TTNHNN prescribing classification of assets, amounts and methods of setting up risk provisions, and use of provisions for control and management of risks arising from operations of credit institutions and foreign bank branches. Currently, according to the regulations of the State Bank, loans are divided into 5 groups as follows. Group 1, standard debts. Group 2, debts which need special attention. Group 3, substandard debts. Group 4, doubtful debts. And Group 5, potentially irrecoverable debts. Group 1, standard debts. These are debts with the best quality. They are the debts that credit institutions assess as fully and timely recoverable, both principals and interests. These debts have not been paid within 10 days. Group 1 debt has a specific risk provision ratio of 0%. Group 2, debts with special attention. The quality of debts in Group 2 is lower than those in Group 1. These debts are overdue for less than 90 days. The bank needs to pay attention to these debts because these are loans that have shown signs of declining solvency but are still considered to be able to recover both principal and interest. Group 2 debt has a specific risk provision ratio of 5%. Group 3, substandard debts. They are the debts which are overdue for a period of 90 to 180 days. Group 3 debt has a specific risk provision ratio of 20%. Group 4, doubtful debts. They are the debts which are overdue for a period of 180 to 360 days. Group 4 debt has a specific risk provision ratio of 50%. And Group 5, potentially irrecoverable debts. They are the debts which are overdue for over 360 days. Group 5 debt has a specific risk provision ratio of 100%. Debts from Group 3 to Group 5 are called bad debts. Here is a summary of the debt classification and the specific provision ratio for each debt group.